Are you struggling because you don't know how to invest in the stock market? Well, let me tell you, investing in the stock market is not an easy game. Many enter with high hopes, only to find themselves crushed and broke after a few months of trading. And if you've already made some of these mistakes, don't think it's too late. Once you recognize these mistakes, you can take the steps to improve. Hi there, welcome to Investor's Game. Today, we're gonna talk about common mistakes investing in the stock market. And give us a thumbs up, that helps us a lot. So let's get started. Investing is one of the best ways to build long-term wealth. As you invest over the time, you are likely to see solid returns and beat inflation. However, not every investing idea is a good one. If you're not paying attention to what you're doing, you could make costly mistakes. Here are some of the most common investing mistakes to avoid. And if you already made some of these mistakes, don't think it's too late. Once you recognize, you can take steps to improve and be richer in the future. Number 1. Stop guessing. Playing the guessing game with your stock market investment is exactly the same as gambling. It is your ability to work with the stock market data and other relevant channels of information that distinguish the two. A real investment is not made on a speculation or based on a rumor that you heard, or a video that you just watch on YouTube, but on a valuable opportunity that you have researched and which looks like it will pay enough long-term profit to justify the risk. Number 2, have a plan and stick to it. Successful stock market investors have a solid plan and they stick to it. New investors, on the other hand, tend to go in blind, like a boat without compass, and therefore get lost and stranded at sea. An investment plan helps you to map your goals and objectives, your entry and exit points, the amount of capital you will invest in a certain trade, any potential risk, the maximum amount that you're willing to lose, and your plans to diversify your portfolio. With these details, you will be able to invest with purpose, according to and against with your own principles. New investors who make a plan may also struggle to stick to it and change their mind whenever the market dips, or whenever an investment doesn't go exactly as they expected. Sticking to your plan will help you to navigate the stock market even when times are tough. This is one of the main points why people lose money in the stock market. Not having a plan can cause you to flat out and make emotional decisions that are out of the plan. Number 3, understanding risk. Every investment comes with a certain amount of risk. Like every business, we cannot have 0% of risk. That is the nature of the stock market and all of investments. New investors often don't properly evaluate the risk of their investment or their own tolerance to that risk. This can cause them to make bad moves with serious life savings. On the other side of the coin, risk aversion can create a psychology of scared money, in which the first-time investor is frightened to take an opportunity that looks lucrative because they don't want to risk the losses. There's a balance to be found, and it lies knowing that every investment is a risk, and also in knowing that margins that are willing to push. Investment in which you stand to gain more, generally but not always, come with a higher amount of risk. New investors fail to think about what they stand to lose, as well as they stand to gain. Your risk tolerance will likely determine your style of investment. Not knowing your tolerance of risk can cost you thousands of dollars. This is one of the biggest mistakes of almost every investor. Because most of the time people see the stock market as a mine that you can make easy and quick money. And everyone knows that having a good plan with established goals and risk management can be a powerful tool. Number 4, not knowing how much is too much. If you're new in the stock market investments and you play with only money that you are willing to invest, then you at least only stand to lose what you can afford. The single most devastating error that the first-time investors can make is to play with money that they cannot afford to lose. This is a direct ticket to complete emotional confusion, irrational decision making, and perhaps even financial destruction. Whether you do, only play with money that is yours. Do not take out loans to invest in stocks, especially if you are a beginner. Don't invest your own reserves. Even experienced investors keep a liquid asset stream. Number 5, selling out in a panic. If you have a long-term plan in place, and you understand that the stock market movement is best understood over the course of the years and not weeks and months. Then you probably won't be in much of panic if stock starts to decline. The stocks rise and fall all the time. When investors trying to look just short-term investments, failing to diversify is the most common mistake. Why some people consider that failing to diversify is a bad idea. This is a huge mistake that a lot of the first investors tend to make. It is never smart to put all of your money in one investment, or even one type of investment. Market can crash and stocks for a single company can go down the drain. What I mean diversify is not buying 20 different stocks as well, because most of the time this is misunderstood. The right way to diversify in the stock market is to have 4 principal types of investment, whether it can be bonds or ETFs. Some investors tend to diversify their investment across several industries and sectors, and have a portfolio that involves stocks in a variety of different companies. Investors who feel intimidated with the market can reduce their risk and increase their diversify by investing in some of their money in mutual funds or index funds, as well as making their own choices in a diverse way. It is also useful to keep assets outside the stock market. Keep some money separate and invest in a hard assets such as gold to diversify even further. Number 6. Short-term thinking. Many investors rush to make their first stock market investment. The stock market isn't some sort of get-rich-quick playground. New investors often enter with high hopes for a steep and rapid profit, and they want to make it big with short-term investments. More established investors have a totally different idea about what makes a short-term and a long-term investment. In their view, a long-term investment may be 20 or more years. And even when they consider it an investment to be short-term, they will probably be looking to stick with it for 3 or 4 years. Don't expect that you will get rich quick making short-terms as you thought, because overall, you probably don't have too much experience in front of the real market for the long term. If you thought you were going to turn a quick profit in a few months, then it's time to reframe your approach to time. Investing is the best seen as a process for a long-term wealth accumulation. Number 7. Start saving and learn about stocks. There are a lot of excuses that people use to explain why they haven't started investing yet, ranging from I don't have enough money to invest, I don't have time to invest in, I don't know what to invest in. The good news is that about anyone can start investing with a small amount of money. Applications and companies that facilitate investing with small amounts are readily available. And remember, the earlier you save and invest, the more money you will have in the future as a result of compound interest. Even if you are getting a late start, though, saving and investing are the bedrock of personal finance. If you like this video, don't forget to hit the like button. Let me know in the comment box, did you recognize any mistakes that you make? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.